Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. It's the 16th of October 2023 and here are the questions we will be answering today. What explains the duality in India's job market? Are Indian family businesses serious about governance? Should investors buy the dips in IT stocks? And what is Operation Ajay? Recent data from the Periodic Labour Force Survey has revealed a perplexing trend. While overall unemployment rate has fallen, the proportion of workers in regular or salaried jobs has also dropped between July 2022 and June 2023. Why is that so? Abhijit Kumar explains in this report.
A recent Periodic Labour Force Survey or PLFS, which is conducted by the National Sample Survey Office or NSO, has come out with encouraging numbers. Unemployment rate in the country has declined. India's unemployment rate fell to a 6-year low at 3.2% in the July-June 2022-23 period. So the percentage of the workforce without a job has reduced, reflecting improvements in job creation and opportunities. The Labour Force Participation Rate or LFPR has also peaked at 57.9% since the NSO started releasing the annual survey in 2017. Labour Force Participation Rate is defined as the section of the working population in the age group of 16 to 64 in the economy currently employed or seeking employment. However, experts have also pointed out that there is a gap in the methodology of estimation of unemployment by the NSO's Periodic Labour Force Survey and Centre for Monitoring Indian Economy or CMIE, which is an economic think tank. CMIE says that there was a fall in the LFPR in 2023, contrary to the PLFS claim. It says that LFPR in 2022-23 was 57% while CMIE claims it was just 39.5%. Analysts say that while the CMIE employs the definition of employment as per the International Labour Organization standard, which excludes unpaid work in LFPR. So beneath this positive headline of the PLFS lies a more complex narrative. The data reveals a significant drop in the share of salaried jobs. Salaried jobs are often considered to be more stable with regular incomes, whereas self-employment consists of a vast nature of work. The latter also includes unpaid household work or petty agricultural labor. This decline has left many wondering about the nature of the jobs being created in India. The share of workers in regular salaried jobs decreased from 21.5% in July 2021, June 2022, to 20.9% in July 2022, June 2023. Experts believe that many traditional salaried jobs were lost during the pandemic, which may have prompted individuals to explore self-employment or gig work out of necessity. The PLFS survey also indicates an increase in the number of people engaged in agriculture from 45.5% to 45.8%. So, what does the PLFS report tell us about the nature of employment in India?
It's giving a mixed story. On one hand, there's the good news, which is that both the labor participation rate, labor force participation rate, and the is going up, and the unemployment rate is coming down. You see, as far as the informal sector is concerned, it has really two components. One is it has small entrepreneurial units, which are not getting into the organized sector for various reasons. The second component of the informal sector are people who are working at whatever work they can get, essentially for survival purposes. And it's very difficult to be able to segregate these two from the data that we have.
And why has salaried employment slipped?
The government's own data is showing that regular work as a share of total employment is falling. And those people are going into informal work.
More specifically, the employment quality has fallen more in some states than others. 12 out of the 21 major states and union territories witnessed a fall in the share of regular income workers. The decline is most noted in Assam, where the percentage of workers in salaried jobs fell by 8.7 percentage points to 10.8%. The figure was at 19.5% in the 2021-22 period. Experts believe that several factors contribute to this dichotomy in India's job market. One key reason is the changing nature of work and the rise of the gig economy. The digital surge has made it easier for individuals to opt for self-employment.
I suspect that those states which had a relatively higher share of formal employees, those would be seeing larger drops. I mean, that's pure arithmetic. But if it's happening in other states, then the question that should be asked is that, is this loss of employment reflecting the fact that formal companies are shutting down or withdrawing from those states? But so that the PLFS in and of itself will not give you. I mean, you would have to look at other data to see, whether there has been a locational shift.
Experts believe that while the fall in overall unemployment rate is a good sign, the shift away from traditional salaried jobs towards self-employment demands attention and action from policymakers. India's ability to create high-quality, stable jobs will be crucial for the well-being of its workforce and the strength of its economy in the future.
Let us now move on to one of the country's largest private sector employers. Reliance Industries Limited, or RIL, was in the news recently after a proxy advisory firm recommended against the appointment of Anant Ambani on the company's board, stating his age as the reason. Anant Ambani is 28. In today's special segment, Kasturi Akhil finds out to what extent large family-led companies are complying with governance norms in India. Let's listen in.
Weeks before the deadline of the e-voting process for the appointments of Isha, Akash and Anant as non-executive directors of Reliance Industries, advisory firm IIAS has recommended investors to vote against Anant Ambani. It attributed Anant's ineligibility to his age. Anant being less than 30 years old does not align with its voting guidelines, IIAS said. It has given a go-ahead to the appointment of Isha and Akash Ambani, who are 31 years old. RIL had made the official announcement of inducting Ambani Juniors to the board at its annual general meeting in August. The announcement did not come as a surprise to most, as experts opine the next-gen Ambanis had already made crucial headway on their journey to the board, whilst helming their respective subsidiaries for over 2 years now.
They have been conscious about first bringing them onto a public platform like a AGM and presenting them there. They have been made responsible for various lines of business, and that has been articulated well in the media and put out as public statements. Reliance Industries itself is a board that is comprised of very eminent individuals and independent directors who I think have a independent thinking of their own. And so to that extent, I would think that they are in a position to safeguard the interests of the company and not just that of the promoters.
It is argued that onboarding family members of the promoter in the company can cast a shadow on its governance and prevent shareholders from full transparency in management and operations of the company. However, SEBI has made it mandatory to include an independent director and has further tightened certain norms to enhance supervision and decision making across the board. A study conducted in 2021 by Balagopal Visa, Professor of Entrepreneurship at INSEAD, found that CEOs who hail from the promoter family are paid more than the otherwise professional CEOs. The family CEO's compensation remains stable during slumps and significantly rises when the firm does well. The study included 277 publicly listed family firms in India. At some of the major family-led groups like the Murugappa, Birla and Godrej, the members from next generation of the promoters, along with external professionals, form an intrinsic part of the management. Earlier this year, the Aditya Birla Group inducted its fifth generation scions, Ananya and Aryaman, as directors to the board of several of its listed companies. The 6-year-long Bajaj family dispute highlighted the vulnerability of a major corporation to internal family conflicts. Siblings Rahul and Shishir Bajaj were at odds over the division of group companies and assets. Meanwhile, the Mahindra Group and Infosys succession plans indicate the start of a new era where India Inc. is led by professionals and not always by family heirs. So, are all family businesses progressing towards this trend?
There are much more smaller mom and pop stores which are also family owned, which are micro and small medium enterprises. So it's not like you can paint everything with the same brush. For all the listed companies or all the large companies, Adani's, Ambani's, they are now more or less following global standards, whether it is vis-a-vis corporate governance, board appointments.
According to Naushad Forbes, former president of CII, many companies prioritize the interests of the firm and ensure that independent views are heard and acted upon.
Today, lot of family companies are having external people make them as advisors and join their board. I see a lot of change in that side. The external people can be in any area of specialization, any area of subject matter expert. They join that organization as a board, and then they guide the family promoters, family businesses to the next level.
India, which has the third highest number of publicly listed family businesses after China and the US, is adapting to transformative trends. However, prudent investors should carefully assess factors such as ownership structures, shareholding patterns, and business agreements before making investment decisions.
The stocks of India's most valued company has given negative returns in the last 2 years. RIL is down about 12%, but the Indian IT pack weighed on the domestic benchmark indices towards the fag end of the previous week after key tech giants trimmed the growth forecast for FY24. Shares of Infosys fell the most, dropping 4% in 2 days. In our next report, we examine the good and the bad from the September quarter results and the road ahead for related stocks.
Shares of Indian IT companies turned tepid towards the end of the previous week as the July to September quarter results underlined persisting demand worries. Shares of IT giants Infosys and Tata Consultancy Services, for instance, declined up to 4% in 2 days ending October 13, while those of HCL Tech rose less than 1%. By comparison, the Nifty 50 and Nifty IT indices fell 0.3% and 2.2% respectively during the period. The drop came after Infosys slashed its revenue growth guidance to 1 to 2.5% in constant currency terms from 1 to 3.5% for FY24, while HCL Tech trimmed its revenue guidance to 5 to 6% from 6 to 8%. Besides, employee headcount decreased across the board as companies went slow on hiring to defend margins. Yet, analysts believe the worst may be over for IT stocks.
TCV, that is total contract value of deals obtained during the quarter, grew remarkably in case of Infosys and HCL Tech on a sequential basis. However, key monitorables include the period of execution of these deals, and any customer induced delays in execution during the course. Given the large deal wins, we do not foresee a large fall in the stock prices of these three companies, and at the same time, upsides also seem limited in the near term.
TCS's order book stood at $11.2 billion at the end of the second quarter, while total contract value for Infosys stood at $7.7 billion. For HCL Tech, net new bookings in the quarter touched an all-time high of $3.96 billion in total contract value. Against this backdrop, analysts believe the pack remains a beacon of strength despite macro headwinds.
With the demand of digital transformation being strong across the world, the IT sector will continue to stay in focus in the next few years. But right now, a number of supply side issues, wage concerns, as well as attrition is sort of causing concern for the sector. The deal pipelines are strong, the accelerated growth of digital transformation across the world is strong. Indian IT is focusing on AI, and this could be quite interesting for the sector.
So, where are IT stocks headed from here on?
Technically, we believe that the Nifty IT index has entered a correction mode, and we believe that it can drift towards 30,640 to 30,300 on the downside. We believe that HCL Tech is one stock which can be bought at current market price for a target of 1400 with a stop loss placed at 1180. While TCS is one stock which we suggest to buy on dips.
Overall, after a tepid sectoral growth in FY24, analysts believe strong inflow of multiple deal wins this year and possible macro recovery over the next few quarters should aid green shoots of growth in FY25. On October 16, markets will react to HDFC Bank's Q2 FY24 result announced over the weekend. Besides WPI inflation and Q2 results of Federal Bank, Jio Financial Services, Bank of Maharashtra and Yatra Online will be on investors' radar.
He's making plans for an early retirement. Business Standard.
After a brief hiccup, financial markets across the globe have bounced back. The impact of the Israel-Palestine war, it seems, has been limited so far. But gold prices soared on 4 consecutive sessions due to it. Moving on, the first batch of around 212 Indians, including students, returned to the country from Israel on board a chartered flight in the early hours of Friday. The return was facilitated under Operation Ajay. Raghav Agarwal tells us more about this operation.
The Embassy of India in Tel Aviv has been working continuously to ensure the safety and welfare of all our Indian citizens in Israel. Yesterday, the External Affairs Minister announced Operation Ajay to help those Indians who wish to return to India. And today, under that Operation Ajay, the first flight is going back to India.
On 11th October, the Indian government announced Operation Ajay to facilitate the return of Indians from Israel and Palestine territories. According to estimates, around 18,000 Indians are currently residing in Israel. And on 13th of October, when the first flight carrying 212 Indians landed at Delhi airport, Union Minister Rajiv Chandrasekhar was there to receive them. India will send special flights to bring its citizens back from Israel and Palestine. The Indian Navy may also be pressed into action if needed. In the past too, the Indian government has carried out several missions to evacuate its citizens from crisis-hit countries. The most recent was Operation Kaveri, launched on April 24th this year. It was launched to rescue thousands of citizens who were stranded in conflict-hit Sudan. A total of 3,862 Indians were moved out of Sudan via 17 Indian Air Force flights and Navy ships under the operation. In 2022, India launched Operation Ganga to rescue its citizens stranded in countries around Russia and Ukraine. The citizens were transported from Romania, Hungary, Poland, Moldova and Slovakia to India with assistance from these countries. Around 25,000 Indians were evacuated under the mission. In 2021, India launched Operation Devi Shakti to evacuate its citizens and foreign nationals from Afghanistan after the collapse of the Islamic Republic of Afghanistan and the fall of Kabul, the capital city, to the Taliban. Around 800 Indians were evacuated under the mission. In 2020, the Vande Bharat mission was launched to bring back Indian citizens stranded in foreign countries during the COVID-19 pandemic. Around 6 million Indians were brought back in multiple phases of the operation. The biggest war evacuation by India was carried out in 1990 when Iraq had invaded Kuwait. In over 2 months, over 170,000 Indians were airlifted in 488 flights and brought to India. Air India was mentioned in the Guinness Book of World Records for carrying out the largest ever air evacuation mission in history.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
According to reports, 17 Indians are stuck in Palestine territories and at least 4 in the war-torn Gaza. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.